show. Venugopal Garre, Managing Director with Bernstein, joins us. Venu, good morning. Thank you for joining us. There are enough and more reasons why one should buy into large cap stocks and one should avoid mid and small cap stocks. But markets are just not obliging. Large cap stocks, especially banks, they continue to languish. Small cap stocks and mid cap stocks, they continue to flourish. Do you think we are reaching a point where risk reward ratio is not favorable now for the broader market per se?
Yeah, this has been one of the questions which has broadly, or a thought which has been going the rounds for quite a bit of time now, as to when to get out of SMIDs and potentially invest in large caps. I would just highlight what I've been thinking about it, at least until now. For me, the broader thinking was that since my top-down Nifty target itself was closer to 19,000, and remember that I'm actually still positive on the market on a 3-year view, with a broader view that one should be buying corrections in the market, at least at an index level. But I had been holding a very positive view on SMIDs until now. And my thinking was that if I look at mid caps at 25x P on a 1-year forward basis, they're still offering you on an average 30% growth, at least the index growth that is there. Well, Nifty is something like 12.5 or 12% odd EPS growth on a 12-month view at around 19x or 18x P. So if you were to just look at broadly from an index standpoint, you may not necessarily essentially see too much of an arbitrage, especially from a fair value perspective. But yes, and the argument could be that, the ratio of SMIDs, multiples to Nifty multiples have expanded, especially over the last 3 to 6 months. And the second challenge that you would potentially find is that it is becoming more and more difficult to get sort of obvious ideas in terms of what to purchase. So you're running out of bottom-up ideas as well, because whatever you see would have gone up 50%, 70% growth rate. So that's like a usual challenge that you usually encounter. Now, my thinking is this, that, broadly this call of rotation kind of a thing is also an element of flows, which essentially which deliver that. Yeah, you could probably look at a situation over a 12-month view. There could be a potentially higher return for, let's say, some of the Nifty stocks compared to SMID. But I think I would still be of the view that some of these SMID stocks, which are linked to very high growth end markets, it's going to be tough to bring them down very quickly unless the growth sort of disappoints. So we should focus more on growth disappointment, because if you were to clearly see one more last thing out in SMIDs, wherever there is not much growth, those sectors have not done well in terms of stock prices. So look at QSRs, for example, or chemicals, for example. So it's not like every sector in SMID has essentially generated a lot of returns this year. So my summary view would be that I guess we still have to look at a situation where one has to take an approach more from a point of view of bottom up. I don't think a large cap, small cap thing potentially works too much. Look for wherever there is growth at this juncture, but overall return expectations still have to be slightly low heading into the next 3 to 6 months, in my view.
What is your understanding about the flows into India? I mean, on paper, there is no argument that India is the best place where you want to incrementally increase your exposure. But if I look at the flows, it's just been on the other side. FIs, they continue to sell, and even though large cap stocks are looking attractive, they continue to sell more. Do you think this trend will only change and reverse post-elections?
Yeah, see, the flows aspect is interesting. Over a 2-year period, we've actually seen negative or outflows from FIIs, if you take a 2-year period, and especially the fact that whatever we saw as inflows in the initial part of the year, we started to see outflows now, right? So to that extent, overall, we've seen an outflow. And I guess a part of that has to also do with, global thought process on fund flows within a lot of global emerging market funds or global funds. And the potential challenge they find is that they're still very heavy with respect to their broader allocations to larger countries like China in terms of allocations. Now, if China is not doing well for them, the challenge that you typically tend to find is a situation where it becomes difficult for them to raise more money. And the number 2 situation which is happening is those funds are also shrinking, because you're actually seen outflows from China, which are not necessarily essentially coming back into the markets or getting reallocated to India. So I would argue simply that it is not just an India thing which primarily leads to these flows, because you can't really raise money just for India that quickly. So it's a very, very tough affair raising global money just for India. So one has to take that into also, a broader context. So I would say that a generally okay China is good for us, especially for emerging markets and for India as well. And number two is, yes, there is a broader worry or doubt or suspicion about what might happen to the next 5 years if elections don't really go in favor of what the market expects it at this juncture. So I think probably there'll be more proactive, allocations or reallocations, which haven't happened until now into India, as compared to passive allocations, which have happened. Passive is, something is not doing well for you and you've not really sold India or as much, so you tend to see an weight increase. But that's going to change probably in 6 months from now, post elections. But I don't disagree with you on that.
Venu, hi, this is Anisha joining in the conversation as well. And correct me if I'm wrong, but I see that your Nifty target is just around 19,000. So you're actually expecting a decline in the Nifty from the current levels. And despite that, your weight on mid caps is just 20%, while bulk of it is made by the large caps. Explain the dichotomy to me here.
Yeah, so just to highlight, I haven't really moved forward in terms of 1 year forward. So this 19,000 is something which was established in April when I upgraded India, when the index was closer to 16,800, which is the broader buy call that I had for the year. Now, the more important thing is that this portfolio that we're running is primarily a large cap portfolio, given the nature of coverage that we have within the team, which is more large cap focused. So what we did is, for the first time ever, running this portfolio, or the paper portfolio as we call it, for the last 3.5, 4 years, we decided to do a special allocation to SMID, which is about 20%. And on top of that, we have one or two SMID cap stocks as well out there, which have 5 to 6% allocation. So this 30% odd allocation, if I were to add that as well, is actually quite large in the scheme of things, that it is a large cap focused portfolio, right? So this itself gives you the message. Number two is, look, I would probably say that this entire thinking about 19,000 or 20,000, it's also a broader construct of, when I sort of move forward, it'll be more closer to 20,000, but that is broadly the range. So I'm not really looking at this juncture, the market to go up above that range. And my thinking is, all these big, not really big, small corrections that you would see is the one which you need to keep buying with a 3-year view in mind. That's the way I'm looking at, basically, or arguing a positive view on India.
So you're expecting the index to stay between that 19 to 20,000 range, but just specifically talking about some of your long ideas, I see Zomato in that list, I see Paytm and delivery in that list as well. What's the view on these after the run-up as well? Would you continue to maintain those long ideas? And why doesn't Nykaa sector feature in this list?
Yeah, so our broader thinking primarily was more centered around business models where we potentially felt that the competitive risks are relatively lower. So that was one broad thinking. So if I look at all the three consumer tech companies that we have, they are primarily dominant players in their respective end markets. And I don't really see them being in a situation where competitive risks are going to be intense. So that's the way the selection was essentially done. So two of them, which basically, one of this e-commerce logistics company and the other is a food delivery company, of course, were introduced much earlier. Paytm was more a recent introduction because the coverage came in more recently, but it's the same situation there. But broadly, overall, consumer tech as a space, we went overweight in January of this year, which was our way to play IT overweight. Right? So that's the way we had sort of squeezed out of their IT services, positions. But that's something we are going to actively be relooking at as to whether to tilt that position a bit more favored towards ID services, for next year.
I wanted to also understand your outlook then when it comes to IT and financials, because it's a moderate overweight on overall IT, while you seem to be overweight financials. Don't you believe that perhaps now the worst in terms of concerns for IT is now behind us, and that maybe it'll be the banks that will take a backseat?
Actually, banks haven't done really well, if you were to look at year to date. Quite a few of these private sector banks, especially the larger banks, including private sector banks, have either flat or down YTD. So, and especially at a time when, things are looking fairly good from a cycle perspective. And I would probably say that when it comes to next year or the year after, it's very less likely that the financial sector doesn't sort of get back its leadership. So I think it pays to be overweight on laggards like financial sector at this juncture. IT is not an easy debate because at least in financial sector, you have a cycle at work where you can actually visibly see things sort of improving over time. And as I say, broad basing of the overall credit portfolio from just consumer oriented portfolio to more an industrial portfolio as things pan out well on the broader economy over a 3-year view. That sort of brings in, some stability of a semblance of, risk level worries coming down, which is what typically, investors worry about at this juncture, that that's still a narrow focused portfolio. So, but in the case of IT, I think it's a much broader call one has to take. I think at this juncture, one can take a valuation call, the fact that the sector has derated and come closer to an earnings growth where perhaps further downward revisions are perhaps less likely. So the nature of the call is very different, I'll probably argue. So we are actively looking at thinking about at some stage, maybe next year, whether we should have a much larger overweight for IT in general. Remember that IT mild overweight that we have at this juncture is funded entirely through consumer tech because it's not IT services, it's actually tech as we call it as.
Venu, there is really something special happening in the US tech space. Looking at the valuations of Nvidia or Microsoft, or for that matter, even Apple now, market caps of trillions of dollars are getting created. If one has to look at that as the mega trend where IT is where all the action and excitement is, what is the best way to participate in India? And Indian IT companies, the large ones, perhaps don't offer this play. But when such exciting things are happening in the tech world, how can Indian investors participate in that?
I would say this is a very important question, but very tough to answer because of the nature of opportunities you get in India. I mean, if you can actually still invest in those global tech companies as Indians, perhaps you should. That's the way I would probably argue as the simplest way to do it. And these are business models which are very futuristic, which are offering you growth, which are offering you global exposure, right? Because they're not like local companies just exposed to the US market, right? So that's like the opportunity spectrum those companies get. But if I were to look at India, see, IT services is a real bread and butter business, which means it cuts across industries. So it's something which is more like akin to a utilities in some way, right? It's a very critical function, but then it's nothing related to pure high tech. It's spread across every industry. So they tend to be more generic in terms of growth rates or more slower in terms of growth rates. So perhaps that's not the right way to play even something like an AI, for example, because that's like an incremental driver, if at all, in terms of opportunities that these companies will get. The other way to look at that perhaps is something like manufacturing. Maybe that's not like a bad approach to look at. If some of these supply chains for tech products start to come out here, which could be, some opportunities with respect to, assembly of anything, be it, a PCB assembly or a assembly of a product, maybe that's not a bad way to look at scale up. All of those are 50 to 60 XP companies, but maybe that's the other approach because you don't really have true high tech per se in India at this juncture. And I don't really see that changing as well, at least in the medium term to long term.
Okay. Now, specifically on IT, because this is like the biggest debate. The purists would say that IT sector has seen the adjustment of Y2K, it has seen the adjustment of SMAC, it has seen the adjustment of enterprise, and yet IT companies have emerged better. The same purists are saying that what is looking like a challenge right now, AI is something which will help Indian IT companies. The naysayers are saying that this time it is different and AI means this is end of the so-called body shop model for Indian IT sector. So it's a hot debate right now. Which part of the debate are you on?
I'm actually in the positive debate. My thinking is very simple that, see, India over the last 30 years has created only one big moat, which is basically IT services. There's a huge talent pool which is available within India. And more importantly, every transition that has happened globally in terms of tech transitions, these IT services companies essentially have molded them to cater to those transitions. And so is going to be the case with AI. AI is actually two things in my view. One is it actually increases efficiency for a lot of these IT services companies. And at the same time, it offers new opportunities within the spectrum of digitization. And I think this entire journey of cloud digitization and throw in AI opportunities, which is, more to equip a lot of these companies to be able to be future ready, IT services pretty much is going to be on the forefront. That's a reality of how things are going to shape up. So I'm actually on the positive side of the debate. The unfortunate reality is that, this sector tends to been given this sort of a treatment of trading at 19 times or 20 times P, where you have sectors like FMCG with similar or lower growth rates at times trading at 50 times P. So, that's the unfortunate reality of how these things shape up. But I think one should be positive on IT over a 3-year view.
It's interesting, really, looking at leveraging that overall AI and new age tech opportunity within the entire space. And I'm curious as well to get in your take then, Venu, on crypto and Ethereum, because that's about 2% of the portfolio.
Yeah, so unfortunately, we had the flexibility of, looking at assets outside of equities as well. I do play sometimes into fixed income, wherever I can. Last year, for example, I had exposure to fixed deposits as well. We had 7% interest rate. So did really well for me till March. And thereafter, I removed that. My thinking this year was primarily that the world is not falling apart. Global, there could be recession, but not like a deep downturn. So what it meant to me that the semblance of broader global stability and US being okay in terms of overall environment primarily meant that there should be some degree of a risk on. That was my thinking, which is the reason why I was short gold and long Ethereum. So and thankfully Ethereum has been working for us this quarter. But that's a broader reality as to why this positioning was sort of created.
Before we let you go, I have to discuss financials, right? You still continue to be bullish around that, given the fact that it's underperformed, you said. But what within financials? Because that too has become a very, very diverse theme. There's insurance, there's, stock market related ancillaries, there's obviously NBFCs, private banks, PSU banks. Within this entire spectrum, what would be your pecking order?
Yeah, so, I normally played around the broader spectrum of our coverage, and our coverage is more centered around banks, not around insurance and asset management at this juncture. But my thinking is that purely from a growth perspective and where they are on valuations, both price to book relative to history and more importantly relative to other sectors on earnings growth as well, we are, and I would perhaps say that the top private banks would be the priority at this juncture, because I don't really have too much regulatory risks to also contend with, for that particular pack. So that will be still at the top of the pack, which is what we are essentially playing at this juncture. I haven't been too confident around NBFC models in general, especially the larger ones as well. So I have, in general kept away from that. So some of the SMIDs have really done well, but the way to play that for me was through my SPIT allocation. So that's the way I am approaching financial sector, especially over the next 12 months.
Always nice to have you. India ka plan kab hai bhai? Let's meet for a coffee when you're here.
Yeah, sure. Very much. Next year.
Chalo, look forward to
Early
that.
next year.
Look forward to that.